Are you tired of endlessly searching for the perfect indicators and strategies that will make you profitable in the market? Are you feeling frustrated with the countless hours spent researching and testing, only to come up short? Well, don't worry, you're not alone. Many traders face this same struggle. However, the good news is that learning more about technical analysis and price action can make a huge difference. And that's exactly what this video is all about, introducing you to a new strategy that can help you predict short-term timing reversals in the market. But make sure to pay close attention to every detail we share, because missing even one key element could make a big difference in your trading success. So, let's get started. Welcome to TQFM Trading Strategies, where we bring you the latest and most profitable trading strategies in the market. In this video, we are going to introduce a new strategy called Bollinger Band Stochastic Reversal. This strategy uses 4 indicators to help traders accurately predict short-term timing reversals. We will define each indicator, explain its purpose in the strategy, and give you the exact settings we use to make the most profit. We'll also show you how to backtest this strategy using Tradingview and give you the results of our tests. So, make sure you follow along and use the free indicators on Tradingview to get the most out of this video. Indicator 1, Stochastic. The stochastic indicator was created by George Lane in the late 1950s. Lane was a technical analyst who believed that momentum precedes price movements. The stochastic formula compares the current closing price to the high-low range over a set period of time and produces a reading that oscillates between 0 and 100. When the reading is above 80, the market is considered overbought, and when it is below 20, the market is oversold. The stochastic is commonly used by traders to identify potential buy and sell signals. When the stochastic reading crosses above the oversold level, it can be a signal to buy, and when it crosses below the overbought level, it can be a signal to sell. The stochastic is a momentum indicator that measures the closing price relative to the high-low range over a set period of time. In this strategy, we use the stochastic with a length of 14% smoothing of 1 and d% smoothing of 3 to identify overbought and oversold market conditions. The purpose of using stochastic is to identify the best entry and exit points for our trades when the price is at a Bollinger Band standard deviation. Indicator 2, ATR. The ATR, or average true range, is a volatility indicator that measures the average range of price movement over a set period of time. The average true range, ATR, indicator was developed by J. Wells Wilder Jr. in the 1970s. Wilder was a technical analyst and trader who believed that volatility was an important factor in trading decisions. The ATR formula calculates the average range of price movement over a set period of time, taking into account any gaps between trading sessions. The ATR reading is typically displayed in points or as a percentage of the current price. Many traders use the ATR to set stop-loss levels and to determine the potential volatility of a particular trade. By setting the stop-loss at 2 times the ATR, traders can reduce their risk exposure while giving their trades room to breathe and potentially profit from market fluctuations. In this strategy, we use the ATR with a length of 10 to set the stop-loss at 2 times the ATR. This helps to minimize the risk of losing money while maximizing profits. Indicator 3, Bollinger Band. The Bollinger Band is a volatility indicator that measures the standard deviation of the price from a moving average over a set period of time. The Bollinger Band indicator was created by John Bollinger in the 1980s. Bollinger was a technical analyst and trader who believed that volatility was an important factor in trading decisions. The Bollinger Band formula calculates the upper and lower bands by adding and subtracting a multiple of the standard deviation from a moving average over a set period of time. The standard deviation is a measure of the volatility of the price, while the moving average is used to smooth out the price fluctuations. The Bollinger Band reading is typically displayed as a line on a price chart. Many traders use the Bollinger Band to identify overbought and oversold market conditions, as well as to confirm trend reversals and potential trading opportunities. By combining the Bollinger Band with other technical indicators, such as the stochastic and ATR, traders can increase the accuracy of their trades and potentially improve their profits. In this strategy, we use the Bollinger Band with a length of 20 and a deviation of 2 to confirm market extremes. This helps us identify the right time to enter and exit trades. Indicator 4. Hikanashi Candles Overlay. The Hikanashi Candles Overlay is an indicator that overlays the traditional candlestick chart with a modified chart to help traders better identify trends. The Hikanashi Candles Overlay was created by Dan Valcu, a trader from Romania, and first introduced in the late 1990s. The formula for Hikanashi candles is based on a modified form of the regular candlestick chart and uses price data from the current and previous periods to create a more smooth representation of price action. The Hikanashi chart shows the trend in a clearer way by using the average price of each candle, which filters out the market noise and makes it easier to spot the trend. Traders commonly use Hikanashi candles to confirm trends, identify key support and resistance levels, and determine optimal entry and exit points for their trades. This particular indicator script was created and made public by CryptoRocks, and we use it with standard settings in this strategy to smooth the price for visual comfort while still using standard candlestick data for other indicators. Backtesting results. We backtested this strategy using Tradingview, and the results were impressive. We ran 100 trades with an account start of $10,000. We had 40 winners and 60 losers with a winning percentage of 40%. The P&L was $539.25, and the average trade was $5.24. The return on capital was 5.39%, and we ran the bars for 1950 with a duration of 5 days. The average win was $27.55, and the average loss was $9.38. The R ratio was 2.937. Based on the backtesting results, the Bollinger Band stochastic reversal trading strategy has some strengths and weaknesses to consider. One of the strengths of the strategy is that it has a relatively high reward-to-risk ratio, R, of 2.937. This means that, on average, the strategy is able to generate nearly 3 times more profits than it loses for every trade it makes. Additionally, the average win of $27.55 is significantly higher than the average loss of $9.38, indicating that the strategy is able to capture larger gains than losses on profitable trades. However, one of the potential weaknesses of the strategy is that it has a relatively low winning percentage of 40%. This means that the majority of trades made using this strategy are losing trades. As a result, traders using this strategy should be prepared to experience some losing streaks and should have a robust risk management plan in place to minimize losses. Additionally, the strategy generated a relatively low return on capital of 5.39%, which may not be sufficient for some traders seeking higher returns. Overall, while the B-band stochastic reversal trading strategy has its strengths, traders should carefully consider its weaknesses and determine whether it aligns with their trading goals and risk tolerance. Conclusion. So, that's it for our Bollinger Band stochastic reversal strategy. We hope you found this video helpful, and we encourage you to try it out yourself using the free indicators on Tradingview. If you enjoyed this video, don't forget to like and subscribe to our channel for more profitable trading strategies. Thank you for watching, and we'll see you in the next video.